Welcome again to my YouTube channel, Accounting Basics Academy. This is your teacher, Maureen. In this video, I will talk about accounting terminologies and source documents. What you will learn. You will learn accounting terminologies or terms, their definitions and examples. What are referred to as source documents in accounting. Accounting terminologies. We have asset, something owned by a business available for use in business. In assets, there are two types: fixed or non-current assets, and then current assets. So the fixed or non-current assets, these are assets which is to be used for a long term in the business and not resold as part of trading activities. For example, machinery, fixtures and fittings, buildings, premises. Those are examples you can find under non-current asset, like computers as well, desks, tables. You can find machinery, equipment, so those are examples used for a long time in the business. Current assets are short-term assets of the business which can be turned into cash within the next 12 months. For example, here I wrote debtors. It's an example of a current asset, but we also have inventory, stock, inventory. We have the bank cash. All of them are under current asset. So those can be turned into cash, within the next 12 months. So we have also liabilities. Liability is an amount owed by the business. It's an obligation to pay money at future date. For example, a creditor. Okay, when it comes to, it's not written here, but also in liability, we have non-current liability or long-term liability. We also have current liability. When we talk about non-current, means long-term. Those loans you owe that is more than, you can repay, over 12 months. Like mortgages, debentures, long-term loans that are, so long as it's over 12 months. But when it comes to current liability, is those example here is, the example given here is a creditor, which is a current liability, like tax liability. These are these are current liabilities, short-term, trade payables, creditors. A creditor is someone the business owes money. We then have capital, investment of money to earn a return. Capital is owed by the business to the owner. It's a special kind of liability. Now let's refer to source documents. These are sources of information recorded in the books of accounts. For example, a simple business, let's say a sole trader. Business transactions are documented on one or more of the following documents. Receipts. We record from receipts, we record from invoices, we record from credit notes, remittance advice notes. Credit note is issued when somebody, a customer or a supplier, you return something to a supplier because you're dissatisfied with the product, they will issue you a credit note. When you issue a credit note to a customer, is because the customer returned the goods to the business, and therefore you issue a credit note. Remittance advice often is issued by the customer to the suppliers to inform them of what they are paying, especially when a customer buys so many items from a business. They will use the remittance advice to tell the supplier, okay, for the amount I'm sending or amount I'm paying for these goods for this date. So just a way of advising the supplier on the amount being paid. Petty cash voucher. and also statement of account. These are soft documents we use. From there we get the information we record in the accounting books. So on the um so on the next slide, you see example of a flow of a document, how it flows. Let's see. So most often, before the price quotation goes from the seller to the customer, there must have been an inquiry. So you're inquiring about the prices of goods. So once you're satisfied with the supplier you want to um, buy the goods from, the supplier will send you their price quotation. So and also then the customer will now make an order, which is a purchase order. And after that purchase order, then there will be a sale, meaning the seller, yeah, the supplier will send the goods to the customer, and the goods will be going with the delivery notes to the customer. And after which the goods are delivered, the seller or the supplier will be sending sales invoice to the customer. And the credit note comes when the customer is dissatisfied, not happy about some part of the goods or all of the goods that was sent to them, or maybe there are damages on transit. The customer will receive a credit note from the seller or the supplier, and then the customer will now send remittance advice, maybe send a check, a remittance advice to the seller, advising on what they are paying. So you see the remittance advice goes from the customer to the supplier or seller, and the check also goes from the customer to the seller. So this topic is part of a comprehensive bookkeeping for beginners, where I have gone deeper with samples of the documents, practice activities, and real examples. So to join other students, follow this link, www.udemy.com /course/how to do bookkeeping for beginners, theory and practical, with the referral code. Thank you for listening.